Today, we're diving into some big news about Labour's first budget in over 14 years and why financial experts are warning families to prepare for some big changes. If you've been hearing about bond yields, rising costs, and concerns over new borrowing plans, let's break down what all of this really means and why people are talking about it. First up, Labour's new budget includes a hefty borrowing plan, around £32 billion extra each year. And this has made quite a splash in the markets. In fact, yields on government bonds have shot up as the market reacts to Chancellor Rachel Reeves' big spending blueprint. In simple terms, borrowing just got more expensive for the UK government, and some are worried that this trend could continue. Althea Spinozzi, who heads fixed income strategy at Saxo Bank, warns that if things keep up, 10-year government bond yields could hit 4.75%. That's even higher than last year's peak. But what does that mean for us? Well, as borrowing costs go up, it often pushes things like mortgages and loans in the same direction. Lee Anderson, from the Reform Party, has issued a warning to families to get ready for more potential market turbulence, calling it a signal to keep an eye on how Labour handles this new economic path. Now, you may remember the market shock following former PM Liz Truss's mini-budget. Darren Jones, the Treasury Minister, said Labour's situation is very different. According to Jones, Labour's approach is backed by the Office for Budget Responsibility, so they're on track to meet their fiscal goals. But some still aren't convinced, saying the market response has been anything but steady. Part of Labour's plan includes a change to employers' national insurance contributions, NICs. This shift is expected to raise £16.1 billion by 2030, but it comes at a cost. Employers could curb wage increases, reduce hours, or even cut jobs. The Resolution Foundation's take, they're calling this increase a tax on working people that will likely show up in their payslips as slower growth. And while Labour promises to keep income taxes steady for employees, some say the next hike might hit workers indirectly. Gareth Davies from Labour's own shadow team called the market's response to the budget embarrassing and worries that this isn't the stable market environment Labour had promised. The pound has also fallen against the dollar after the budget release. While the Treasury and the International Monetary Fund have backed Labour's approach, the markets don't seem reassured just yet. So, what does all of this mean for you? If borrowing costs keep rising, we may see higher interest rates trickle down to personal finances, from loans to mortgages. While Labour insists they're on track for fiscal stability, these market jitters show there's still a lot of uncertainty. What are your thoughts on Labour's new budget? Are we on a sustainable path, or are we headed for more turbulence? Drop a comment below. We'd love to hear your take on this.